The income approach to valuation is a widely used method in apartment investing that estimates property value based on its potential to generate income. This approach is particularly useful for income-producing properties like multifamily apartments. Two primary methods under the income approach are the capitalization method and the discounted cash flow analysis. By applying these methods, investors can assess the property's current and future value based on expected cash flows, allowing for informed investment decisions. Key concepts in the income approach to valuation: capitalization method, purpose and process. The capitalization method determines the property's value by dividing its net operating income by a market-determined capitalization rate. The cap rate reflects the investor's expected rate of return for similar properties in the area and the perceived risk level. Net operating income, or NOI, is calculated by subtracting all operating expenses, like property management, maintenance, and taxes, from the property's gross income. It represents the income generated by the property before financing costs. The cap rate varies based on property type, location, and market conditions, providing insight into investor expectations for risk and return. For example, suppose a multifamily property has an NOI of $120,000 and the market cap rate is 6%. The property value is calculated as $120,000 divided by 0.06 equals $2 million. This calculation suggests a market value of $2 million based on its income-generating potential at the specified cap rate. Discounted cash flow analysis, purpose and process. DCF analysis estimates the present value of a property by forecasting its future cash flows over a specified holding period and discounting them to present value using a discount rate. This approach is especially useful for properties with expected growth or varying cash flows over time. Forecasted cash flows. DCF includes all expected future income, typically over 5 to 10 years, along with a terminal value representing the property's sale price at the end of the holding period. The discount rate reflects the investor's required rate of return, accounting for the time value of money. Higher discount rates are often used for higher risk investments, while lower rates are typical for more stable properties. For example, assume an investor expects a property to generate annual cash flows of $150,000 for 5 years, with a terminal value of $2.2 million in year 5. If the discount rate is 7%, the present value of each cash flow, including the terminal value, is calculated and summed to estimate the property's value. Example: valuing a multifamily property, using the capitalization method. To estimate the value of a multifamily property with an NOI of $90,000 and a market cap rate of 5.5%, divide the NOI by the cap rate. 90,000 divided by 0.055 equals approximately $1.64 million. This indicates a value of approximately $1.64 million based on current income and market conditions.